Yes, sir, you are.
Yeah, thank you. Thank you, Ms. Hira. Very good afternoon, good morning, and a good evening to all our attendees from the globe. So, my name is Asim Shehzad, and I'll be your host for the next couple of hours for this webinar. Uh, let's be honest, for us who are into this finance and accounting field, IFRS often less seen as a standard, but more of a saga that constantly demands a reread. Post COVID, in last few years, in last 4 5 years, this plot has only thickened, and we are even the most meticulous CFOs sweat when they come across application of the IFRS. So right now, it's the simply applying IFRS is not very enough. And the real frontier for presentation and the disclosures, we are telling the and we have to like more concentrate on the financial story. And are we telling this financial story effectively? Are we managing the non-financial disclosures effectively? And that is why we are all here. And uh, before starting the inviting the speaker, I just wanted to give a itinerary that how we'll take this webinar up. So first of all, I want to warmly acknowledge that this session is a joint session uh, co-hosted, organized by ICMA UAE, ICMA KSA branch, and Canada branch. And how we'll take it forward is that first of all, we will have introduction of our speaker, and after that, the speaker will go through the topic, and at the end we will have question answer session. During the webinar, you're all allowed to post your questions on the chat box, and at the end we will take those questions, those burning questions, and our speaker will be happy to answer those. And at the end we'll end the session with a vote of thanks. So now, so Mr. Ayaz Mustafa is our speaker for today. He has more than 15 years of experience. He was into the academic side as well. He started back in 2008. Throughout till date, he has trained a lot of professionals around the globe, not just in Pakistan, but around the globe. And he has his expertise both in academic side as well as towards his professional side. Right now, he's the head of accounts and finance for HBL Investments in UAE. Over to you, sir.
Bismillahirrahmanirrahim. Thank you so much. I'm very thankful for all the branches for giving me this opportunity to share my knowledge. So I hope that my screen is going to be visible, and it's now visible. Can you confirm me, please?
Yes, it's visible now.
Okay. So I also welcome all the worthy participants for this webinar. As you people know that we are going through the series of webinars on IFRS. In the last, we already did IFRS 9. Now our today's agenda is IFRS 18, and we will also look at the IAS 7, which is statement of cash flows, because it is like a same topic. So IFRS 18 presentation and disclosures in the financial statements. As we know that today's world is going to have a evolving transparency. So mastering IFRS as an accounts and finance professional is a very need of the hour, so that every accountant must be updated especially when IFRS 18 is going to be implemented from the 1st of Jan 2027. So first of all, let's start with a very basic idea. In the first section of this webinar, that what is IFRS 18, what is the need behind it. So what is the background of IFRS 18? We all accountants who have qualified a few years ago, even who have recently qualified, they know about IAS 1. IAS 1 was related to presentation of financial statements, but the name was not the disclosures as well. So IAS 1 was related to presentation of financial statements. So IAS 1 has already guided the financial statement presentation for decades, but lacked consistency and comparability across the industry. So I will discuss these things, that what was the comparability at that time and what is going to change in today's world. So why there is a need to these changes? So investors required a clearer distinction between operating, investing, and financing results of an organization in a more structured subtotals and better linkage between profit and loss and cash flows. We know that previously the previous standard was having profit and loss in a different way and statement of cash flow in a different way. And then we normally reconcile by following the indirect method while preparing the statement of cash flows. Now the things are going to be aligned. So objective of IFRS 18 is to improve transparency, consistency, comparability of financial statements by introducing standardized categories. So the word is standardized categories. So in IAS 1, there was some things which are not clear. They are not defined. It is up to the discretion of the decision maker that where to classify anything. Now they have standardized these categories and better defined subtotals. So we will discuss that what are the new subtotals in the IFRS 18 and how it is going to be changed in a few months. So if we compare IS 1 and IFRS 18, I am comparing so that I can link with the previous knowledge and I can tell you that what is going to be changed. So as far as name is concerned, presentation of financial statements, now presentation and disclosures. So IFRS 18 is much focused on disclosures requirements. Then statement of profit and loss, previously no prescribed structure. We can make like a traditional way, like a revenue, cost of sales, gross profit, operating expenses. But now it introduces three mandatory categories. So in the P&L, we must have our P&L in operating, investing, and financing activities. So just like in the statement of cash flow, previously you were dividing your activities into three heads. So same is the mandatory requirement under IFRS 18 that now your P&L should have these three mandatory categories. We will discuss all these things in detail. Then subtotals. Entities defined their own. Previously, as per IS 1, many entities used to calculate operating profit margin, other ratios like EBITDA, and other ratios. So now they have defined, introduced the two mandatory subtotals in the P&L. So what are these mandatory subtotals? They said that every P&L must have operating profit. So one line item must be having the operating profit and profit before finance and income taxes. So technically, it is going to be divided into three. Like operating activities will be showing the operating profit. So we can see that how operational our operations are, whether they are financially viable to run the business, how much company is getting profit from the operating activities. Then profit before financing and income taxes. So it will effectively show you the impact of investing, that how much is the impact of investing and operating collectively. So this line item will give you the profit, you can say that, which is profit before financing and income taxes. So it means after this line, you need to have finances, cash profits and expenses, income and expenses from the financing activities, then taxation, then you will arrive at a final. And another thing, which is comparable with IS 1 and IFRS 18, that is the management defined performance measures. In the IFRS 18, it is repeated so many times that MPM, management performance measures. Previously in the IS 1, they are disclosed in management discussion and analysis. So what are these MPMs? So I will explain that what were these things. So just to give you an idea, like earning before interest and tax, earning before interest, tax, depreciation and amortization. So these things were not there in IS1. But now, if you are doing these things in the management discussion, so your company is following the EBITDA and all these measures, which are mostly discussed in the management accounts of the companies. Now, IFRS 18 says that these things must be disclosed in the notes with the reconciliation as well. So I will give you illustration that if your company is having this profit, this is the EBITDA, how you need to disclose in a reconciliation way. Then cash flow linkage in the IS1, there was no division of profit into three categories, but now it is just like a statement of cash flows. The difference will be the timing difference. In the statement of cash flows, we will be incorporating based on the actual cash inflows and outflows, whereas in the P&L, we will be following accrual accounting, but uh, under three categories. Then statement title. In the IS1, the name was statement of comprehensive income. And now it is just like same name. It is allowed to have the same name, but now it will be divided into profit and loss and other comprehensive income. Then disclosures were general requirement that what you need to disclose in the statement of financial position, notes to the account. So you need to have general disclosures in IS1. But now more quantitative and tabular disclosures for subtotals and management performance measures. So I will show you practically that how things are going to change in the notes to the financials. Then comparative period. Standard retrospective restatement was allowing in IS1. Now mandatory retrospective application with full reconciliation. So I have a slide as well which will reconcile retrospectively from IS1 to IFRS 18. So what were the management performance measures? Earning before interest and tax, EBITDA, earning before interest, tax, depreciation, and amortization. Then sometime we adjust the profits, underlying profits, core profit, adjusted EBITDA, net debt to EBITDA ratio. These are all the ratios that normally as an accountant we present or we discuss at a management level. So I will share the slides so you can read it. This is just to give you an idea that these management performance measures were ignored in the IS1. But now IFRS 18 says that if you are discussing these things in the management accounts, you are also supposed to disclose these things into the notes to the financials, and you need to incorporate these things in the disclosures along with any reconciliation. So I will show you the reconciliations as well. Now, what is the summary of key changes? New structured income statement, as I told you that it should be operating activities. So what is the operating activities? These are the main business revenue and expenses generating activities. For example, if you are running a property business, then your routine items of income and expenses will be different. If you are a bank, you are having a different income and expenses stream. And if you are a manufacturing company, you need to know that what are your basic revenue generating activities and what are your revenue expenditures. So all these things which falls under the definition of routine revenue and income activities, they will be classified as operating activities. So nothing new. It is same as IS7 was saying about the statement of cash flows. So it is the same definition, same things. Then investing activities, the returns from financial assets. Now, financial assets like you are investing in the shares of the other company, you are giving loan to others. So these are financial assets. We have discussed the financial assets in the last webinar of IFRS 9. And at that time, I linked it with IFRS 18 as well. And then financing activities, we know that we are taking loans, and same as we are taking funds from the shareholders. So all the inflows and outflows or income and expenses, I'm using the word income and expense instead of outflows, because if I use a word outflow, it will give you a message like a cash flow. So income and expenses related to financing activities will be the interest income, interest expenses. Now, you can see that previously in the IS1, you are normally recognizing interest expense in the operating expenses. Under IFRS 18, you cannot do it because standard clearly defined that all the financing income and expenses should be under the head of financing activities, not in the operating activities. So this is a major change that we can say that. And previously, it was your discretion that you will be charging it. Same is the case with the statement of cash flows. We can charge interest outflow in the operating activities and the financing. Now the things are clear that you need where you need to present it. Then there is a mandatory subtotal of operating profit and profit before financing and income taxes. So operating profit, that profit you are generating from the operating activities, then you are incorporating the profit and expenses related to investing activities, then you will arrive profit before financing and income taxes. Then you will incorporate the income and expenses from financing activities and taxes. Then you will be arriving at a net profit for the year. So what are the subtotals? As I explained to you that operating profit or profit generating from an entity's main business activities before investing and financing results. So it's clear that it should be before investing and financing results, purely operational matters. Revenue and expenses from the core operations, for example, cost of sales, employee cost, depreciation, selling, admin expenses. Just I have written a few examples. It excludes income and expenses like dividend from investment, gain or losses on disposal of long-term assets, financing, income expenses like interest, income expenses. So all these things are not part of your operational income and expenses. So exclusions are very important in IFRS 18. So keep in mind, previously you were mixing it in the operating expenses. So now it is not going to be the case. So what is the purpose or insight? The measures of the operational performance, because companies wants to see that how successful my operations are. So it means it is just like the management accounts. Previously, the work of accountant was double. One is statutory accounts, one is management accounts. Now, the statutory accounts and the management accounts are going to be the same. So there is no need to prepare two things. So it is the requirement of the IFRS 18. So operating profit will be giving you the picture that how successful your operations are based on the accrual accounting. Then profit before financing and income tax. So it means we have already calculated operating profit. Now we will be adding or subtracting investment income. If it is an income, you will be showing as an addition, and if there is an expense, you will be deducting. But still before financing and taxes. So standard requires that you are not going to mix financing and taxes here. So it is just like the statement of cash flows, but it is in the accrual accounting. Then all the operating results and investing results, like share of profit from the associate, investment gain and losses. So these things will be included here. So what are not included? Again, finance income, finance cost, and income tax. So what it will shows performance before the effect of capital structure, because we know that if you have a different capital structure, your performance, your net profit will be different. So again, without the impact of financing, the management can see, even the shareholder can see, and they can make an informed decision in this regard. So I hope that the things are getting clearer with the passage of time that I am changing the slide. So I am conveying a few basic concepts so that we can understand a fuller picture. So what is the summary? Introduction of the management performance measures. It is required to be mentioned in the disclosures along with the reconciliations. Then improved cash flows classification aligned with P&L. So it is just like the same previously non-finance managers, many people in the board are technical engineers. So they will be sometime having issues that this statement is showing something else. and this statement is not showing any categorization. So now it is aligned. Then enhanced disclosures, nature of the income and expenses by function or nature. So I will describe you these things, that what is going to change here with reference to expenses according to function and nature. Then material items are also disclosed separately. So I will be explaining these 2 points in details. Then new terminology, statement of financial performance. Normally for P&L, they are using now statement of financial performance, so that you can assess that how successful your operations, investing activities, and financing activities are. If we talk about the financial statements, A is primary statement remains the same. So what we know, statement of financial position, financial performance, statement of changes in equity, statement of cash flows, and notes to the financial statement. So these are the same 5 things that you need to prepare, but separate presentation of income and expenses by category. I already explained these categories. Then clear subtotals and definitions consistent across the periods. And then management performance measures. If you are using any, you need to describe in detail in disclosures along with the reconciliation. Then consistent classification across P&L and cash flow statement. So it is the summary so far that we learned, that what are the changes, what is the comparison of IAS 1 and IFRS 18. Now, as I told you that many companies are using earning before interest, tax, depreciation, and amortization as a measure, EBITDA, which is commonly used in accounts and finance. So if we have profit, let's assume it is 250. We have finance cost, we have depreciation, we have restructuring cost. So all these costs are this one, and you reported your management EBITDA 370. So previously, these calculation you were doing it internally, but now as per the requirement, if you are using any management performance measure, so you can use, but you need to disclose it in the disclosures along with this type of reconciliation. So this is just like a calculation. It is not the part of your P&L. It is the part of disclosures. You need to make these type of reconciliation. So basically, in simple words, I can say that we need to make working note for all the performance measures that management is using, so that your shareholders can also use the same mindset. Previously, only the key board of directors and the key management employees were using these, but the shareholder was not considering these things. So nowadays, with the passage of time of the evolving transparency, the companies are now and the shareholders, even the regulators, are also interested to know these things. So that's why it is need of the time to incorporate these things in the disclosures. So it is the reconciliation of any management performance measure. So it is one of them. If you want to use any other, like return on capital employed or something like that, you can do it. There is no fixed list. So you can add any management performance measure in your financial statement, but do you need to show the working and the reconciliation, you can say. So disclosure requirements are management performance measures, operating category, investing, financing, tax, and interest, consistency. So all the 4 points I already explained. So consistency is the same old meaning, policies for classification and comparability across the period. Now, the point is that if you are classifying something in this period as operating activity, you cannot change its category in the next period. So if you want to change, then there must be some reliable information, there must be some reliable or more better presentation, there must be some logic you need to justify. So basically, consistency here refers to the consistency in the classification of the activities and comparability with the different periods. Then disclosures of the management judgment in the categorization. So categorization, again, a new terminology. I will explain that what is the categorization in IFRS 18. Transition impact. Because as at the start of our today's webinar, I said that it is going to be implemented from the period which is starting from 1st January 2026. So it means now we are in a transitional period. So quantitative reconciliation between IAS 1 and IFRS 18 presentation. So we need to make a bridge that if my financials will shift from IAS 1 to IFRS 18, so how it will be a different scenario. So I have working with you that this was your old P&L, this will be your new P&L. So transitional impact, what is the meaning? When an entity first time adopts IFRS 18, it must show in numbers. It is the requirement of this standard. How would it previously reported in the financial statements under IAS 1 and look after being restated under IFRS 18? That is the quantitative reconciliation, a numeric bridge. So as I told you that you are just playing a role of bridge, that we are shifting from this to this. So how your statements will be under previous standard, under the new standard. And the purpose is to have transparency and comparability of this working. So it means users, investor, auditor, regulators must be able to see what changed, where each old line item went. So where it was previously, now where it is going under the new structure, and whether the total profit is the same. So that they cannot have any confusion in mind that sometime we feel that shareholder is saying that last year something else, now something else. So you need to show, you need to translate each line item, and you need to mention where it is going. So it is not about changing the profit. So the purpose is not to change the figures. It is about showing how presentation categories, operating, investing, finances have shifted. So it is the objective. Now, I have divided this transition into 3 steps: before transition, during the transition, and after transition. So what to do before transition? We need to assess the impact. This is a general habit of the accountants, that when we are going to change, for example, from one ERP to another, so we assess the impact. So identify where the current IS1 presentation differ from IFRS 18. So by the end of this session, you will be much aware that what are the changes. So for this point, I will be helping you to assess the impact, that what is going to change from IS1 to IFRS 18, and defining the operating versus investing and financing activities of your business model. So again, if you are a bank, then interest income, interest expenses are your operational activities, not financing, because you are a bank. So again, the word is of your business model. So you need to define accordingly. The same if you are a property company, so rental income and rent related expenses are your operating activities. But if you are a manufacturing company, but you have part-time investment property as well, so that will be a investing activities, not the operating activity. Then update the chart of accounts mapping, because you are going to change the face of your BNL and all these things. So maybe you need some mapping of the existing chart of accounts. And if there is any new required, so you need to map. Then review the management performance measure used internally, for example, EBITDA, core profit, and prepare. Previously, you were not preparing the reconciliations, but now you will be preparing the reconciliations as well. So that's why you need to know that how to prepare the reconciliations. Then educate finance team and management on new presentation structure. So this is the very important role of you people as a head of accounts, that you need to educate your finance team as well as your management, that now what we are using internally, we must show these things to the financial in the financial statements for the stakeholders. Then what to do during the transition? Prepare parallel financials. So same model that we are using when you are changing an ERP from existing to new. So you normally prepare old and new. So under both IS1 and IFRS 18 for comparative periods. Updating the accounting policies and disclosures, implement the changes in ERP and accounting software. So you need not to change your reporting in the Excel. If you are using any software, better to customize your reporting structure and consult with your consultant, and then you need to change the software reports as well. Otherwise, maybe some people will be in the old format in the software, and then they are adjusting their financials in the Excel and then presenting it. So better to make these changes in the software as well. Discuss with your consultant whether these things can be customized or not, something like that. And prepare the transition note showing the restatement of the comparatives. So these are the things that you need to do during the transition. Now, this is the practical example. On the left side, you can see that there is a statement of profit and loss under IS1. Revenue, cost of sales, gross profit, selling, admin, finance cost, other income, which is investment gain, profit before tax, 230. When you are going to change it, so revenue, cost of sales, selling and admin expenses, operating profit. Then investment income, then profit before financing and tax. So these are the mandatory subtotals I was talking to before. That standard requires these two mandatory subtotals. Now it's up to you. If you want to have GP, no problem, you can make. GP, you can show. But standard requires these two compulsory subtotals. So if you want to make GP, no issue, you can make GP. No debate on that. But you need to classify as per this. Then investing income, then profit before financing and taxes 280. Then you will incorporate the finance cost. If there is any finance income, you can add, and then profit before tax. Now you can see that this is a comparative shifting from one to new. So that is the bridge I was talking, that you need to make comparative so that your shareholders, your management, your regulators can see that nothing has been changed, only the place is changed, and it is categorized accordingly, that operating, investing, and financing activities. So I hope that everyone is clear that what is going to be changed. Is there any question so far? If there is any, so we can ask. I guess no question. Okay, I will check.
I did not see yes, sir.
Yeah,
What
sir.
questions?
There is just one question as of now that I can see is that if
Okay, okay.
profits will be same, so it's restated FS or reclassified. That's the only one. So I believe this is clear from your current
Basically,
slide.
I'm using the word restated here, from restatement from IS1 to IFRS 18. So presentation is changed, not the restatement that we normally use that to change the figures. So figures are not changed. That was my disclosure at the start, that we are not going to change the figures. We are just going to place their position in as per the requirements of IFRS 18 in the three categories.
Thank you, yes, sir.
Okay, okay.
So
Yes,
you can carry
now,
on, and I'll be sorry, Asaf. I just wanted to add that you can carry on, and I'll be like writing the questions, and then during the session we can
okay,
then
okay,
ask the questions.
okay.
Okay.
Actually, I was in a need of a small water break, so that's why I have offered you the questions. Okay, coming to the point. After transition, review the consistency of disclosures each period, then communicate the impact of management, auditors, and the boards, benchmark against the peer companies for presentation alignment. So these are the things that how you are doing and how your peer companies or the competitors in the same industry are doing. So these are the things that you need to do after transition. Annual reporting periods beginning on 1st January 2027. So if you remember, I told you 1st January 2026. So what was the reason? Because when the year of 2027 was ending, then you need to compare with the previous year. So technically, you need from 2026 as well. So this is, as a subject matter expert, I am giving these words to everyone, that you can assume that you are going to implement it from 1st January 2026, because standard allows you to implement it in advance. So that is a voluntarily as well. So you can start it now. Otherwise, complete your this year in the same way. Then in the next year, you will be in the transition phase. So at that time, you need to have these two types of report in your system. So you can start well in time now, and you have a full year. So the same point that compare in both models, so that will also be okay. So this was the best time to learn these things and to start it with the uh, aim that you will be as per the new requirements. So early adoption is permitted with full disclosures, and transition retrospective application with comparative representation. So I'm not going to give you that you need to change this year, last year. No need to be too much voluntarily. So you need to be from the coming year. So you can adopt it in the transition phase as well. Now, these are the things that I was saying, that there is a new idea, new classification, aggregation and disaggregation. Aggregation, we know that to club something, disaggregation mean to divide. So aggregation and disaggregation are the guiding principles that determines how information is grouped. In IFRS 18, it is very important concept to learn that what is the rule behind to club something or to disaggregate something or to break down in a financial statement. So what is aggregation? Combining similar items that share common characteristics and are not materially individually. So they are not material individually. We already know the definition of material. I'm not going to be in detail. So basically, criteria is that if you want to club something, it should be similar item with the common characteristics and are not material individually. So it means if individually it's a material item, disaggregate, don't club it. And disaggregation, separating or breaking down the different items that have distinct characteristics, functions, or nature when it provides more useful information to the user. The goal is to balance understandability and relevance. You have you have seen these words in many standards, that aim is understandability and relevance. So the same objective is here in the IFRS 18, that we need to make the financials understandable, and as well as we need to have them as a relevant one. And important point is that too much aggregation hides inside. So that's why it was written 2 3 lines up, that if they are material individually, then don't aggregate. So that's why too much aggregation hides the inside, and too much disaggregation causes the clutter. I have practical illustration to share with you that how disaggregation causes a clutter. So you can see here. Presenting excessive details, because disaggregation means to divide it into different categories. So it means you are going to present excessive details. It can make the financial statement confusing and cluttered rather than helpful. For example, if you are going to split the revenue into 5 product categories and each one is material, this is very good. You need to do this segregation. So useful disaggregation. So there are 5 major categories. They are all material. You need to disaggregate it. Revenue split into 50 minor categories. For example, there is a revenue. Now 50 lines in the financial statements for revenue. And some less than 1% of the total. So it means you are confusing. So it is not going to be a good disaggregation. So too much disaggregation causes the clutter and distract the reader. And showing the depreciation by every single asset. So you have 10 assets, 100 assets, no need to show every line for each asset to show separately. So unnecessary detail. So you need to avoid unnecessary details. So standard has clearly mentioned that you need to be clear on aggregation and disaggregation. And standard has given the criteria, the same I told you, I will repeat that criteria at the end as well. And showing the total depreciation by function. Yes, this is good. Because as I told you a few minutes back, that you need to divide into functions in nature. So you need to classify as per the function, as per the nature. So you can divide the depreciation separately related to manufacturing in the cost of sales, and a head office admin related depreciation as a separate line. So it is appropriate to disaggregate these two types of depreciation, but showing each asset's depreciation as a separate, so it is not recommended. So this is the example that too much disaggregation is causing distortion for the reader. Why IFRS 18 emphasizes these concepts? Under IS1, companies had wide discretion in grouping the item. So it was the company's choice. This often resulted in inconsistent presentation across the entities. So at the start, I told you that we want to make comparison within the same industry. Then miscellaneous or other line items hiding the key drivers. So previously, we are normally looking in the financial statement, we have miscellaneous expenses, other income. So there was no clear direction. It's up to the entities. They normally classify with these words. Different classification practices, for example, some showing the administrative expenses as one line and other showing detailed breakdown of the admin expenses. So this is just a one example. Now, IFRS 18 fixes this by requiring that whenever you are disaggregating or aggregating, there must be a clear principle-based criteria for when to aggregate or disaggregate. So it is not the choice of an entity. So we need to be on the principle based with a clear criteria and consistent application of those criteria across the period. So as I told you, you are not going to change it immediately, not in every period. Explanation: when aggregation or disaggregation choices materially affects the user's understanding. So again, if you are going to disaggregate or aggregate, so it is affecting the user's understandability, then you need to disclose in the disclosures as well that why I'm changing, I'm disaggregating or I'm aggregating this. Asim, is there any urgent question to be answered here? If there is anything related to this, we can discuss it, because I am seeing that there are different messages.
So now we're getting few questions. We have
Okay, better to take it here so that we can move forward with clarity.
understood. Just one sec. So this is one question when we said that GPU is not mandatory. So the question from Salman Yamani is that for our fuel business, we calculate cents per gallon. That is based on GP. So in the new structure, we'll have to show GP as well before this subtotal.
Yes, it shows GP. Normally, you are not going to eliminate GP. You can show it. Standard does not say that you need to eliminate it. Standard only requires two compulsory subtotals. So rest of the things you can follow. So GP is makes sense that we need GP. Even if you will say to any company that I don't want to show the GP, so that is not sensible. Doesn't make sense. So GP must be there. But after GP, subtract the operating expenses, make operating profit. Then investing, then the other subtotal was profit before financing and income tax. So these two mandatory requirements, operating profit and profit before financing and income tax. So these are the compulsory requirements. The rest of the things are same.
Okay, so next one is, I'll quickly take few. If some of the operational cost pertains to the investment, does IFRS 18 provide any guidance on apportionment?
What could be the example? If you can just explain that, if there is, let's assume that there is a scenario. Some part is operational and some part is investment related. So you can apportion it. But I guess if you are doing some investment and you are incurring some cost purely related to investment, like in the IFRS 9, that there is a transaction cost involved, you buy the bonds of the other companies, so you pay some finance charges, processing fee. So they are incorporated in the uh, investment. So better to treat it as an investment. But if you feel that this is purely operational, then you can. But normally, I'm not getting right now in my mind that what could be the example of this hybrid model. So normally, if something is related to investment, so the cost you are incurring related to investment.
Understood.
If he will share
Next
any
one is,
example, then we can discuss it. Maybe he will share with us any idea.
sure. So the next question is from Anil. So from statutory audit Q1 2026, if we apply, so auditor will allow us, we can
Yes,
just apply.
voluntary adoption is allowed. Even
Okay.
your auditor will tell you, just after completion of your 2025 audit, let's say you are ending on 31st December, your audit will be in March, April, it is completed. Your auditor will tell you that try to shift your financials as per the IFRS 18, because they know that from 2027 it's compulsion. So they are also giving you this idea. You can see that from 2026, everyone will be learning IFRS 18. So it is the plus point of ICMA that they are now considering that this is the best time to convey these things. So this this is just a one session of 2 hours. I cannot give you the whole picture in this 2 hour session, but this is good to apply voluntary. And your auditor will also encourage you in 2026 to follow it.
Thank you. Another one is a quick one for aggregation, disaggregation. Is there any threshold to decide about materiality?
Yes, materiality normal principle, that what is the definition or criteria that if something can change the economic decision of the user. So that is a materiality. Same way you can define, your auditor can tell you if you are not able. So same criteria, that if you feel that in hiding something is changing the decision of the user, so don't hide it.
Another on the aggregation, IFRS in 18 introduces new requirement for aggregating and disaggregating line items. What guidance or threshold exists to determine? So I believe this is already answered.
Yes,
So
this is already on the screen as well, and I have illustration as well. So he will get more clarity. So the rule is basically you must have a clear principle-based criteria to segregate it. So what is that criteria? I'm just going to explain in detail in 1 or 2 slides.
understood. Another one is depreciation is charged separately in notes in admin, selling, and COGS. Does this presentation says anything about aggregation and presenting depreciation in operating expenses in statement of performance?
Yes, agreed. The any depreciation on the manufacturing equipment, if you are a manufacturing company, so you can charge the depreciation in the operating expenses, operating category, and then admin is also operating category. So you can disaggregate, just like in the previous slide, I have shown that depreciation of all assets line by line is not recommended. It will create extra burden, it will confuse. But if you want to segregate depreciation, you can logically, functionally, you can disaggregate the depreciation into cost of sale, into admin, into other heads.
Understood.
That makes sense.
Got it. One last one we'll take. It's from the Salman. He previously said that we take this fuel business where we calculate cents per gallon. That is the based on GP. So he has another one that for our fuel business, we regularly pay finance cost to the money lenders. Normally, we show it as our operational expenses in our management reporting. And based on the management requirements, the business must absorb
Now
it. So
standard
normally
has
it should
stopped
be
it. Now standard has
okay.
stopped this. Standard has clearly defined that if any interest expense you are paying, it is
Mhm.
finance. You cannot report
It's
it in the operating.
fine.
So that was my starting point, that previously you were free to show it anywhere. But now standard has fixed that finance related income and cost, whatever is that, if that is financing, so it is under the financing.
Okay, so one last we'll take. Sometime companies not prefer to provide details of revenue product wise to avoid that to avoid the data to reflect to the competitors. Is the concept of aggregation is subjective or it is compulsory to reflect the details?
Standard says that if you want to make your revenue more clear, understandable, so better to provide. So again, in the previous slide, I was saying that look what your peers are doing. If you are not dividing it and peers are dividing, so it is not good thing. So you need to compare with other. But normally, what I recommend to my participants in the trainings, that if you are providing products and services, then separate product revenue and service revenue. Do not go by each product. You can do it. You can do this aggregation. Standard is not compromised. But if you are providing products and services, better to disaggregate product revenue separate, services revenue separate. So this is my recommendation.
So I believe we can like now move
Anything
forward on the
else?
presentation and then I will take another question. There
Okay.
was like one last
So
question.
further, I am going to discuss aggregation and disaggregation in detail. Aggregation combines the item with similar characteristics. We have discussed that it should be with the nature, function, or any measurement base into a single line item or the subtotal. And examples are combining the different types of office supplies. So same nature, you can mix it in admin expenses. No need to make supplies each separately. So you can aggregate if they are not material. Combining the minor income sources, for example, a little you are getting interest, a few commissions, small gains you are also getting. So they are not material individually. They can be aggregated under other incomes. And what disclosure is required? If aggregation might obscure the material information, if you feel that by doing this aggregation, you can hide some material information, additional note or the disclosures are required to explain what is included. So basically, if you feel that something is not to be aggregated, it should be separate, better to make it separate. But if you feel, on the other hand, that in this way my financials will be too much confusing, so no problem, you can aggregate, give a note that these things are aggregated, and you can show the working as well, just like a reconciliation. Disaggregation means separating components of a line item that are dissimilar in nature, function, or measurement basis if it enhances the user's understanding. Now, the condition is if it will enhance the user understanding, then you can disaggregate. When to disaggregate? They are different in nature of income or expense. For example, product versus services. So as I told you, that if you are providing, you are selling the products, you are also providing the services. So you can divide revenue into line items. Then different functions, for example, cost of sales, admin expenses. Just I told you that you can divide any expense into two heads because they are functionally different. And different measure basis. For example, one thing is at fair value, other one is amortized cost. And let's say you have the financial assets, bonds. One, you aim to hold it till maturity, and other one you can sell it. So if you are holding any financial asset till maturity, standard says that better to follow the amortized cost model. And if you are going to sell it in future, you can recognize it as fair value through OCI. And if it is a trading share, you can classify it as fair value through profit and loss. So it means in the same head, there can be three different measurement bases. So if you feel that there are different measurement bases for each item under the same head, you must disaggregate it because the measurement base is different. And when the materiality thresholds are exceeded, so someone has asked that what is the materiality threshold? So you can judge it as per your company's profile and the company's financial figures. So you can define your materiality level. So if something is exceeding that, so hiding that major information can mislead the user decision. So better to disaggregate it. So these are the criteria: nature, function, measurement basis, and materiality. So someone was asking that what is the criteria? So answer to that question is this one. Example, revenue includes both product and services. We have explained that it must be disaggregated in notes or on the face of the statements. Some people will say that, okay, I don't want to show two lines in the revenue. I want one. No problem. Show one, give the note. So in the note, describe it. Operating expenses combined as marketing and depreciation. Many companies do this. Operating expenses, they club all because there is not too much, they are not individually material. So if they are not individually material, you can club them, give the details in the disclosures. But if it is significant, anyone is material, you should disaggregate. Do not mix the marketing and depreciation in one head, do it separately. Finance cost includes interest on borrowings and lease liabilities. So both leasing and borrowings have the interest element. So you cannot club, you cannot aggregate. Better to give you a visibility of borrowing finance cost as a separate, leasing finance cost as a separate, because if you will club this, it will affect the economic decision of the user. So main aim of all the financial reporting standard is to ease or is to give the transparency to the shareholders and all the regulators and everyone who is interested to read your financials. So give them a transparency so that they can make informed decisions. So you cannot club these two types. So this is just an example. I'm just giving you a vision that how you can think about these things, which is going to be implemented in a year. What are the disclosure requirements? Entities must disclose the basis of disaggregation. So as I told you that nature, function, geography, product line, and ensure the consistency across the reporting period. You cannot do that this year you are disaggregating, next year you are aggregating. So better to follow the same pattern to make the financials comparable. Interaction with materiality and the categories. IFRS 18 explicitly ties aggregation and disaggregation decision to materiality. So I have already discussed this in detail. That first thing is materiality, functionality, nature, each of the three performance categories. So when you are deciding something, as I given you example of interest on borrowings and interest on lease. So both are financing, but you need to disaggregate into two lines. So this is the same. And disaggregation must not contradict the subtotals or the definition. For example, you cannot mix the operating and investing expenses in one line. So there was a question as well that if something is operating, something is investing. So all the same, but you cannot mix these because it will be a contradictory with the standards requirement of the subtotals. That operating profit will be separate and profit before financing and taxes will be separate. So it is the requirement of the standard. So it is going to contradict the subtotal concept. So do not aggregate anything which is in a contradiction to the subtotals concept. Now, what is the practical guidance for implementation? As an accounts manager, you should review the current financial statement line items, identify where the different natures, different natures of the functions are being combined, then determine the aggregation logic. If you are going to aggregate, what is the logic, what is the reason, define the internal policies, expenses of the similar function should be aggregated. So you need to define it and identify the disaggregation triggers as well. So what is the threshold when you will be doing disaggregation? You need to define it. Update the chart of accounts as per the new changes, prepare the notes template and documentation as well for the audit trail. So it means everything you are going to do as an accounts manager, you need to follow these 6 criteria: that review the current position, then what is the aggregation if you are going to aggregate something, because standard has allowed to aggregate, so you can do it. And standard has also allowed you to disaggregate. So which things you need to be disaggregated, you need to do working as per your business model, and update the chart of accounts accordingly. For example, as a result of aggregation, you are merging 2 accounts. So you need to adjust your chart of accounts as well and prepare the notes and the templates that how these things will be doing. And you need to do some documentation work for aggregation and disaggregation decision. So you can take approval from the board that or from CFO. You need to keep proper documentation for audit purposes. Now, this is just a small example. That revenue, cost of sale, operating expenses, profit before tax, 1,000. This is normal. Now, revenue, 2 lines. So basically revenue is disaggregated. Cost of sale, previously only 1 line. Now material, labor, depreciation, overheads, anything. So you are now disaggregating, making the things clear that how it is 7,000. So you can see that out of 7,000, 4,500 is my material cost. So why material cost is more percentage? You can do further analysis in your management discussion and analysis. So basically, as I told you at the start of the webinar, the time is coming that when the management accounts will be most likely the same as the statutory accounts, because previously all these things you will be looking in the management accounts, you will be doing analysis accordingly, and you will be discussing all these things at management level. Now, standard has allowed you to disaggregate if you want to do so. Then operating expenses are further categorized as marketing, admin, lease expenses, then operating profit. So it is just an example to show you that how disaggregation will practically work. So each category now provides more insight and aligns with IFRS 18 structured presentation. So key takeaways from this concept of aggregation and disaggregation. IFRS 18 makes aggregation and disaggregation on a foundational principle rather than judgmental. So previously IS1 was giving you the authority, bid, no issue. Now they have shown that there must be transparency, comparability, clarity, and materiality, functionality, nature. And IFRS 18 fundamentally changes the format and structure of financial statements, not by altering what's presented, but how it is organized, categorized, and disclosed. Now, how each of the 4 primary financial statements and notes to the financial statement will look under IFRS 18 compared to IS1. Now, whatever I have told you, this was just to explain these coming slides, that what will be the impact on P&L, what will be the impact on statement of financial position, statement of changes in equity, statement of cash flows. So now I am going to present the original thing. So all these working was just to keep you people with the new knowledge. And now you will see that what is going to change. In the P&L, although P&L is already discussed in detail in the basic concepts, So no prescribed structure was there in IAS 1, operating profit not defined. Normally, currently, we are calculating operating profit in management accounts. Then entities freely determine the subtotals in the management accounts. Finance, income, expenses, and the taxes shown variably. You can show it at any place. Now, under IFRS 18, there is a visible change that you need to clearly define to place where to place these things. We have seen that. So what is the structure of IS1? It was flexible layout. Now, it is not a flexible layout for P&L. Mandatory structure divided into three categories of P&L: operating, investing, and financing. So if after 1st Jan 2027, if you are not following this, so it means your financials are not as per IFRS. You cannot claim that. So it is a mandatory. Then your P&L should have operating profit and profit before finance and income tax. So it is a mandatory subtotal. So again, if you are not doing it, your financials will not be as per IFRS. Definition of the categories. In the IS1, there was no categorization in P&L, but now there is a clear definition I have already explained. Then management performance measure were not in the part of IS1. Traditionally, we are preparing financial statement and we are preparing the management performance measures for internal use in the management accounts. But now it must be disclosed in the financial notes to the financials along with reconciliation. And then consistency with cash flow. Nothing is required in IS1. It was different way, but now when it is divided into three heads, so it is just like the same in the statement of cash flows you are looking at that time. So now both will be same. The difference will be the accrual accounting and the cash accounting. So as per IS1, this was a simple. Now you can see that operating categories: revenue, cost of sales, operating expenses, operating profit. Then investing, share of profit from associate. This is your investment. Then profit before financing and income tax 62,000. Then financing categories: interest expense, profit before tax, and then profit for the period. So now you can say that it is much more like a storytelling. Just like I am conveying you the IFRS in the same way as IFRS 18 is expecting from you as an accountant to present your reports. So I'm not just going to give you one slide that this is the change, this is this. So the purpose of the whole discussion is to give you an idea with a clarity so that you can apply what IFRS 18 actually requires. Now, statement of financial position. Under IS1, previously assets and liabilities are classified as current, non-current. There was no linkage of the categories with P&L and grouping largely judgmental. So this was your old story on the left side. Now, what is the right side? Overall formats remains similar. So we are not going to invent any new balance sheet. It will be assets, liabilities, and equity, same. But overall, it is same. But aggregation and disaggregation principle must be applied consistently. Clear subtotals and classification. Now, if you want to do subtotals in alignment with the P&L, for example, you want to divide your assets as operating assets separately, investing assets separately, you can do it. You can discuss with auditor, you can discuss with your management, and it is very much common, even if you know that in the management accounts, we normally calculate return on capital employed based on operating capital. So now you will be having a clear picture of the operating assets. So you can also aggregate, disaggregate, and you can link with the P&L categories. So clear subtotals and classification aligned with the nature or function of the asset, and terminology refined for clarity and linkage to the performance categories. So you can say that in the assets, you are also going to divide it. But again, it is not the mandatory division. So far, IFRS 18 has not given the word mandatory segregation of operating asset, investing asset, not a mandatory requirement in statement of financial position. But in the P&L, that was a mandatory subtotal requirement. So in the balance sheet, this is not mandatory, but you can link it in the same way. So presentation, in the previous IS1, balance sheet was current and non-current. Now it is retained. Standard does not say that do not write the current, non-current. You can write, but enhanced consistency in grouping. Previously, line items disaggregation were judgmental, but now must disaggregate when the items differ in nature or the function or materiality. Same criteria we have discussed in detail. The same rule of aggregation and disaggregation will apply to the balance sheet items as well. Terminologies, assets, liabilities, equity. So same terminologies in IFRS 18, but additional subtotals. Total operating assets, optional. Now you can see that in the last slide, I was saying that it is not mandatory. So it is optional. If you want to align with the P&L categories, you can align it. And linkage. There was no linkage in IS1, and now it is encouraged to link operating, investing, and financing assets and categories in the P&L. So it is encouraged. Now the time is to encourage you, but maybe there will be a time that when it will be a mandatory as well. Statement of cash flows, I'm skipping it because my today's topic is IFRS 18 and statement of cash flows. So statement of cash flows, I will explain after that. So because I need to link it with IS 7. So I'm not explaining, you can see that from second, I'm directly jumping to 4. So 4 is statement of changes in equity. Statement of cash flows, I will explain just after a few minutes. Under IS 1, already required to show the reconciliation. So this was old story. It was required that opening retained earning, opening share capital, everything was there. That is the current scenario. And limited detail in the presentation. But now, format remains largely the same. So I need the same statement of changes in equity, opening, closing, but enhanced disaggregation requirements for each components of OCI. Other comprehensive income. For example, you have investment in bonds and you have classified as OCI. So this should be a separate line item. You have investment in shares, you classified as OCI. So it should have a different line item. You have the fair value through profit and loss. So that should be a separate line. So now the impact on the equity should be disaggregated in more detail and clear linkage to the corresponding line items in the new structure statement, and must identify the management performance measurement adjustments. If management performance measures affect equity movements, also if there is some management performance measures which are affecting the equity as well, so you need to show that movement in the equity in statement of changes in equity. Reconciliation was required in IS1. The same reconciliation is required in 18, but now disaggregation is also added. OCI classification was broader. Now it must be clearly mapped each OCI component to operating, investing, and financing. So each operating other comprehensive income should be separately divided. And management performance measures were not applicable in the IS1, but now it is applicable, and you need to show if they are also affecting the equity. Notes to the financials. Under IS1, it followed a sequence, basis of preparation, accounting policies, supporting information, flexibility in grouping. But under IFRS 18, it must include new mandatory disclosures. So what are the mandatory disclosures? Management performance measures is a mandatory disclosure. Disaggregation disclosure is also a mandatory disclosure. If you are categorizing it, you need to explain how items are classified into operating, investing, and financing. Then transition effect. Quantitative reconciliation from IS1 to IFRS 18. If you remember at the start, I have shown you that this is your P&L under IFRS IAS 1, and this will be your new P&L under IFRS 18. So this is the mandatory disclosure, so that the shareholders can see that the things are same, but their place is changed. So this is mandatory disclosure. So this is the summary of these disclosures. Show the calculations, purpose, and reconciliation. Then disaggregation, if you are disaggregating nature, function, all these things we have already discussed. So it is the same thing. What you as an accounts manager should do. I already have one slide, almost the same meaning, that review your chart of accounts, remap all income and expenses into these categories. So it is the work as a head of accounts. You need to classify your chart of accounts into these categories. Then template redesign. There may be some change in the format in your accounting system, so you need to redesign. As I told you, that discuss this with your ERP consultant, that you want now these things. Then disclosure planning. Prepare new notes templates for management performance, because previously there was no reconciliation required for EBITDA or any other management ratios. Comparative restatement. Run 2026 financials in parallel, IAS 1 versus IFRS 18. So this was my opinion as a subject matter expert at the start of the webinar, that you need to do it from 2026. So run parallel both streams. And board and the auditor communication. Explain visuals and structural differences to management and the auditors. So you need to discuss these things so that everyone, every stakeholder will be aligned what you are doing. For the profit and loss, completely restructured into 3 categories, along with subtotals and management performance measure. Statement of financial position, create a greater disaggregation and optional alignment. So it is optional that you can divide your operating asset, investing asset, financing asset separately if you want. But to start with, the standard is not giving you a mandatory classification in the balance sheet. It's a voluntarily classification of the assets. Then cash flow, it is almost same. Just in the cash flow, the place of interest and dividend is changed. I will explain you. So for the time being, you can believe. Changes in equity, more granular breakdown and linkage to the new categories, and notes new sections for management performance measures, disaggregation, principal, and transition effects. As I told you, that a bridge between IAS 1 to IFRS 18. Now, is there any question? I guess I need to complete it, then I will answer the questions. Because
Yes,
already we have.
Yeah, we can have at the end of the session.
Yes, yes. So statement of cash flows, IAS 7 was the second topic in our today's webinar. What is the objective of IAS 7? Purpose, first thing is objective, to provide information about cash and cash equivalent movements during the period, classified by operating, investing, and financing activities. This is your normal IAS 7. The goal is to help the users to assess the entity's liquidity, solvency, and financial adaptability. How the cash is generated and used. Why it matters. Cash flow is the most objective measures of the financial health. Profit can be manipulated by accruals by changing the cutoff dates. So there is a long debate. We can do it. We can do these manipulations, but cash shows the real performance. So that's why many companies are also looking at the cash position to check the liquidity, solvency, and financial adaptability of the company. There were 3 categories. We are all familiar with these categories: that operating, investing, financing. What are the definitions? We have discussed this. What are the examples? Normal revenue receipts, revenue payments, expenses, taxes, uh, investing activities, asset disposal, acquisition, then gain, or purchase of any property, plant, and equipment, including intangibles, equity investment, bonds investment. So these are investing activities. Financing, like issuance of shares, issuance of debentures, bonds. Then leasing is also under the financing activities. So these are the normal categories that we have in IS 7, statement of cash flows. There were two methods: direct method and indirect method. Direct method is very easy to understand for non-finance professionals who are not having the finance background. They can simply check that there is a cash receipts from customer, then payment to employee, supplier, then cash generated from operations, income taxes paid. So this will be the cash from operating activities. Then second head, investing activities: sale purchase of non-current assets, sale purchase of bonds of the other companies, sale purchase of the shares of the other companies. So it will be showing a net cash from investing activities. Then financing activities, you are issuing your shares, you are issuing bonds. So all these things are part of financing activities. Now, this will be the net cash from financing activities. Then there is an increase, decrease, then cash at the start, and then you will be having the cash and cash equivalents at the end of the period. So this was the direct method as per the IS 7, but standard recommends indirect method. So yes, this indirect method. In the indirect method, it is starting from the profit before tax. We will adjust the non-cash expenses and non-cash gains, working capital changes. Then we will be having the same answer of the net cash from operating activities. The rest of the investing and financing activities are same. There is no change between direct and indirect method. So the approach, what is the difference between direct and indirect method? There is a approach difference. One is starting directly receipts and payments. Other one is starting from profit, because sometime if a non-finance professional is looking at the financial, he will say that profit is this one, how the cash is this one. So there is a like a reconciliation in the indirect method, that the reason of the difference in the profit and the cash flow from operations are these points. So it is giving you like a reconciliation. But now when IFRS 18 will be there, so profit and loss is already categorized on accrual basis. So direct method was easy to understand. Indirect method was this easy to understand for non-finance professionals. For finance, indirect is also easy. And the purpose is to check the actual cash flows, and the purpose of indirect method is to reconcile the profit with the cash flows. These are the key disclosures requirement as per IS 7, that your components of cash and cash equivalents, short term, highly liquid, within 3 months, less than 3 months maturity, they are part of cash and cash equivalents. Non-cash transactions must be disclosed separately. Asset purchase via lease. So these things were the requirements of IS 7 to disclose, because they are non-cash. So they must be disclosed in the notes. Then reconciliation of liabilities arising from the financing activities. So this was the requirement in 2016. So this was the new requirement at that time. Now we are used to it. Then foreign currency cash flows, use the exchange rate if you are paying in the other currencies. So on the date of cash flow, transaction date, you will be using the rate. Interest and dividend. Now you can see flexibly allowed. Interest and dividends are flexibly allowed. You can put it in operating activities or financing activities. This was IAS 7, but IFRS 18 has cleared that. So this thing will be different. I have the next slide for comparison, that what is changed as per the requirements of IFRS 18. Then policy disclosures must also be there, that how you are recording anything with a consistency. from period to period. Interest paid can be operating or financing. Interest received can be operating or investing. This is what you are doing under IS 7. Dividend, operating or investing. Dividends paid, operating or financing. Income taxes paid, generally operating, unless specifically linked to investing and financing. So normally it is operating. Now, IFRS 18 effective 2027 will align these with P&L categories, removing the flexibility. So now the time is changed, the requirements are changed, and you also need to be changed in this respect. Now this flexibility is finished. As per the IS 7, key judgments and the common issues. Classification. So you will be classifying accordingly as per the normal routine. Non-cash items, foreign currency. This is the same thing I just summarized in a tabular way. As an accountant, understand the business cash cycle to correctly classify the inflow and outflow. Maintain a clear mapping between GL accounts and the cash flow categories. Use the control accounts to reconcile or to do some reconciliation from any account that you feel that there need to be any reconciliation in the cash flows. Then document judgments, then monitor the consistency across the periods and disclosures. So these are the IS 7 disclosures. Now, upcoming IFRS 18 linkage with statement of cash flows. So this was the third statement that I skipped at that time, and I said that I will explain this after a few minutes. Now, under IS 1 and IS 7, three categories were there. Classification was not linked to P&L. Entities could classify interest and dividend inconsistently even. You can do it. But now, categories must mirror those in the statement of financial performance. Performance means P&L. So it means the same categories should be there. Now, what we decided in P&L for interest expense, we said that interest expense will be financing expense. So it means now in the cash flow, you cannot put the interest expense in operating. You must put the interest expense in financing. Interest and the dividend classification must be consistent with how the related income and expenses is presented in the P&L. So as far as your statement of cash flow is concerned, it is just one change that IFRS 18 is giving you a mandatory classification that you must do interest expense in the financing. You cannot do it now in operating. So I hope that you got this one. IS 7 was independent, but now you are not independent. Interest and dividend, you have the options to classify, but now you have a fixed treatment. In IS 7, operating activities were residual activities. Residual mean first identify investing, first identify financing. Now whatever left is operating. So at that time, residual activities were classified as operating. Now, same definition, that routine revenue generating activities, routine revenue generating expenses, so they are operating. Disclosures were limited. Now, enhanced reconciliation for clarity between the categories. So now you need to give disclosures as per the categories. So what are the takeaways related to statement of cash flows? As per IFRS 7, it requires three categories, same three categories in IFRS 18. Both direct and indirect methods were allowed with reconciliation. Disclosures related to non-cash, foreign currency, and financing reconciliation. Now, as per IFRS 18 has strengthened the category alignment and disclosure and discipline. And classification consistency and the clarity are keys to audit the readiness and transparency. So basically, there is not a major change in the statement of cash flow due to IFRS 18. Only one flexibility is finished, you need to follow IFRS 18 when you will be adopting it. So it's up to you. You are going to adopt it as a volunteer from 1st Jan 2026 so that you can compare both models, old model, new model. And then from 2027, it's a mandatory adoption of IFRS 18. IFRS 18 brings greater structure, discipline, and comparability. Clear subtotals will improve the investor's understanding of the core operations. Management performance measures disclosures enhance the credibility of non-IFRS and GAAP matrices. So it means previously, if you are not following IFRS, you are not following the GAAP. So it means now management accounts and statutory accounts, whatever you are doing in the management accounts, it is recommended to give these in the disclosures as well. Then, as an accountant, you need to plan your transition. You need to do the mapping and accounts. Mapping the accounts early will save your time. So do more research on IFRS 18. I tried my level best to give you an idea that how these things will be looking after a year. So again, I will be available. My number was on the first slide. When you will get these slides, you will get. And in case of any confusion, any future clarity, you can feel free to discuss with me. So I hope you have unlocked the mystery of IFRS 18 and now you can turn this clarity into confidence. I wish you good luck and thank you so much for your patience listening. And one disclaimer I want to give you that many people were expecting that maybe I'm going to give you how to make the calculations. So basically nowadays calculation is not a challenge. The challenge is to understand the real law, real requirements. Nowadays system is doing all these calculations. So because I'm linked with the students as well, so student texted me, sir, can you solve this statement of cash flows question in our today's webinar? So the webinar was related to the understanding the reporting requirements as per the new law. So that's why I tried my level best to create an interest for all of you to understand these standards. So inshallah, I will be patiently waiting for you people in the coming webinars as well. With these remarks, this is all from my side. And now you can ask me the question. So Asim, if you can help me to answer the questions.
Thank you, Sir. I'll just move on the questions. So we got some interest in this seminar. We have a lot of questions. So I'll take few. One of it is that do you think IFRS makes the PNL on cash PLN making the the question is a bit ambiguous, so we'll move to another one. Your comment on IFRS 16, is it synchronized with IAS 18, where depreciation on leased assets will be in operating category, but the interest on lease will be financing category?
And for this, we have the next webinar as well. So IFRS 16 is coming. So I will discuss it in detail at that time because now it will be like I need to do more work for this answer. So I need to build a base. So inshallah, in the coming webinar of IFRS 16, I will link it at that time.
I have one question for myself as well that, Mr. Ayaz, do you think that the new IFRS 18 is a disclosure overload? Already, like we are already the accountants are overloaded with the disclosures. So what's your comment on that one?
No, what is your exact question that it is
The
overlooked?
question is this, yeah, what I'm saying is that IFRS 18 is a disclosure overload. Like we have to do now the management accounting
Yes,
part.
yes, it is having a lot of requirements, but it will be like a new normal. Just now
Mhm.
we are discussing it for the first time or maybe second, third time. So it feels like there is some extensive requirements, but with the passage of time, we will be used to it. So it is not too much. The coming years, as I have written one line that in this evolving transparency, world. So there are much more to come in the coming years. So everything requirements are coming more complex and complex. The next few years are only to follow the requirements, because now AI and all the softwares has helped the accountants a lot to make all these things. So the things are going to towards the more transparency. So when more transparency, more requirements. So for present, yes, it is having more workload, more requirements, but it will eventually benefits the accountants, that no need to make two set of accounts for
Mhm.
management separately and the statutory account separately. So just after the transition, you will see that it is good.
Thank you. Another question is, again, it's for the IFRS 16, and there's a question from Ali Asudullah. Currently, we are following this presentation for SOCI, Statements of Comprehensive Income. How this presentation will change after adoption? Appreciate if you could briefly explain this.
Which statement he's asking?
Statement of Comprehensive Income. How this presentation
So
will
same
change after
PNL
adoption?
I have explained in detail at the start.
Categories and so
So I request you to watch the recording so that I can answer any other question.
Okay.
I already explained
One
it.
more, yeah, one more question is, uh, as you have said, we disaggregate the assets into operation and investing in financial positions. So what will be about depreciation on these segregation and how it shows in profit and loss? Please explain.
As I told you at the time of profit and loss, that depreciation should be classified as per the function. So if functionally it is not operating, then you cannot charge the depreciation in operations. So for depreciation in the P&L, functionality will be taken into account. So almost it will be same. If you are classifying any asset as an operating asset, so definitely its depreciation will be operating depreciation. If you are classifying any asset as an investing, so it will be same.
Understood. One last I'll take. Interest cost on EOS and ROU, right of use. So we classify in operating or financing.
Financing.
Okay.
Lease,
So
as I told you, that borrowing and leasing, so that is finance.
okay, so I believe I have these are the main questions. So now, thank you so much, Mr. Ayaz, uh, for this very insightful and very wonderful presentation. And we and this like will build a base for us for future adoption of IFRS. And based on your experience, I can really see that how you made this very easy for everyone to understand and comprehend. And I believe that the attendees who took their time, like on Saturday Eve, they made a very right choice, and that will benefit them in the future. And now I'll hand over the stage, the virtual stage, to Mr. Mashood Ali Dilhan. He is our Vice President for UAE branch, and it is for the formal vote of thanks. Over to you, Mr. Mashood.
Thank you very much, Asim. First of all, I want to say thank you to all the attendees as well. That it's very difficult nowadays to spare the time for your learning, which is must, by the way. And I appreciate, I was observing the attendees, the same attendees from the start till the end, 2 hours, which is showing a very good passion and dedication from all these attendees. So I congratulate to them that yes, there are many options are available, but they valued this training from ICMAP, which is also showing another indication that Mr. Ayaz is making it very easy for all the attendees to understand it. And the first webinar went very well, and as well as Alhamdulillah, the second webinar. Thank you very much, Yasab. It's a really wonderful session, and it is you were answering the questions before the questions were going to be raised, which is honestly, as a trainer, is a good grip you have. And we are very thankful, especially to you, because voluntarily you are sparing your time and you are paying back to ICMAP and to finance community. Uh, we can just say thank you. We have nothing more than that
Welcome. My
to
pleasure.
say to you, honestly. uh, and I appreciate the efforts of chairman technical sport and practice development committee, Mr. Asim, and his colleagues, because the program which you are now observing, it's not the just 1 week working. It's have some detailed working and thorough engagement with the ICMAP, the allocation of the time slots and all these kind of things. So a lot of had to be done before reaching to this stage. And I appreciate to you and your colleagues who worked. And I also appreciate the other ICMAP branches, KSA branch and Canada branch, because this is the collaboration where we decided that by collaborating we can save the time, we can engage more people, and the purpose is just to help the more professionals for understanding and learning. And that is also very wonderful idea, and it's going very well. Special thanks to ICMP Krachi, Ms. Hira, Shfiq Saab, and Asim Saab, and all the team members, because this is not possible without your help. And especially continuously, we know this is not only the one webinar where you are engaged on daily basis. There are a lot which you people are engaged as a facilitator to the members and for their development. Thank you very much again to you and all the ICMAP team. And I would like to say thank you also to my all colleagues, ICMAP branch council, and especially our chairman, Mr. Rizwan, which is continuously supporting us, encouraging us to continue. And it's a service to the community, and really it's a wonderful passion. And I would request to join this passion. You will really taste it. With all this, inshallah, looking forward to you see in our next two further series. And inshallah you will learn more and more, and based on your feedback, inshallah, we can develop further programs. And I will appreciate to you that you can give us your feedback, and that will help us to further update ourselves, and it's kind of the appreciation, encouragement as well. And we must encourage each other when we are doing voluntarily good. With all this thing, I think we
Sir,
can yes, Hira, please.
thank you so much, sir, for your kind appreciation. We also have few words of appreciation from Mr. Azim Hussain Siddiqui, Honorary
Yes,
Secretary
please.
and Chairman, National CPT Committee for Ayaz Mustafa Sahab. He said Mr. Ayaz had a wonderful presentation. He just covered the topic in depth and had excellent explanation and elaboration. Thank you so much, Ayaz, sir. It's a pleasure to have you. Thank you all.
Welcome,
Thank
welcome.
you,
And
Azim
this
Saab.
is really an honor for me that Azim Bhai said this for me. So I'm honored. Thank you. Thank you so much.
So
Welcome, sir.
stay tuned. See you on next Saturday. Thank you very much.
Welcome.
Thank
Thank
you,
you.
everyone.
Bye.
Thank you. Thank you.